Hello and welcome to the Monday Call. I'm James Gregor, and joining me today is Mark Brooks, CIO of NZ Funds. Mark, last time you and I spoke, markets were experiencing a pretty sharp downturn. This was, if you remember, Liberation Day, so to speak, on April the 2nd.
Seems like a world ago.
It does seem like a world ago. We were actually in that podcast quite vocal about the opportunities we saw in adding to growth assets, as we believe some of the recent decline that we saw was overdone. At the same time, during that time, we were waiting for further economic data from New Zealand and monitoring volatility, which was quite elevated. And all this was coming over the line because of tariff announcements, global uncertainties. I think everybody's pretty au fait with what was going on. So it's been about 6 weeks and a lot has changed. Today, we should probably cover all of these things. So what I wanted to discuss is what's happened with markets over the past few weeks, our positioning, what we did during the volatility and where we're at now, but also the look ahead. So we can use perhaps the recent budget. We're recording this Friday, so the budget was yesterday. Let's talk about some of the implications on New Zealand and the markets, but also the wider economy. But also it's a really good chance to do a bit of to geek out a bit.
Compare and contrast as well.
Yeah. And Mark's done quite a bit of work around comparing US and New Zealand from a fiscal standpoint, which gives a bit of context, because I think sometimes we do compare things apples with apples, and actually it's not quite the same, is it?
And I think, and this is jumping ahead of it, but as tariffs maybe not fade into the background but become less of an immediate issue, the narrative, especially in the US, is changing to what is happening with their budget. Their deficit.
Absolutely, and we saw that overnight, again, Thursday night, New Zealand time, with passing of different bills in the US around taxes and spending and things. Cool, well, we've got an hour, or just a bit less, because I've rabbited on too much in this intro. Let's get to it. Where should we start?
Should we start with, I suppose, what's happened in markets and how generally we've viewed it? And I think I'm just trying to remember back to when we spoke last time, but a lot of what we do, we look to, I suppose, to history to say what has happened in the past. And really that's a reflection that, history doesn't repeat, but it does rhyme. And certainly, can we use history as a guide? And in terms of, I suppose, events like the tariffs, we haven't had an event like the tariffs, but we've had similar ones. And, in many respects, you can boil down sharp or market declines. And I hesitate to use the word bear market, but sort of where you get a decline of 20% or more, into sort of three broad types. The first and probably the most dangerous is when something is actually broken economically, and examples of that would clearly be the GFC. In New Zealand's case, probably the finance companies and all the lending that happened with that. So usually there's often a banking component to it. But when you get those are deep market corrections, in excess of 25% usually, and long. It would take you 2, maybe 3 years to recover. So, and that was, I think, in terms of our reaction profile to tariffs, there was a concern initially that tariffs had an ability, or their tariff announcements, the scope of them and the magnitude had an ability that if other nations really chose to sort of fight those head on, that had an ability to really create something broken in global trade. Once we saw our willingness to negotiate, in fact, that the tariffs were kind of a starting point, that took that off the table from our point of view. So, and then you get the other two versions of economic declines. One is an event. Think about ones we've seen, clearly a 9/11 type event, something that is not necessarily economically driven. It's a force from outside. COVID is a good example of that. And, they tend to be very sharp down and a very sharp back up. And actually that's what we've ended up seeing this time. And markets, in the US, share markets are above where they were on Liberation Day. Not above where the peaks we saw in February, but above those levels. In New Zealand, where well above the levels we saw in April, at the start of April. Again, probably not, we're not positive for the year, but we're well above the tariff sort of event.
Because at its worst, what? Nasdaq down 20%, S&P 15, and New Zealand about the same, 15.
Yeah, I think I'm not 100% sure on New Zealand, but broadly, yes, yeah. Nasdaq sort of got a bit through, and I think the S&P actually probably peaked to trough, was close to 20, but that was off a February peak. In terms of the tariff, I suppose the tariff news in those couple of days, that was sort of down 15 on that basis. So.
And perhaps it has got from peak because the market was a bit of a sieve over in the US, and perhaps people knew about the tariffs a little bit sooner than.
Look, I think markets are very good at pricing in. They continually look to price in information as it evolves. And in our outlook at the start of the year, we had a couple of, and I think we had it in the tariff presentation. Sort of a thought map as to what was driving people's thoughts at the beginning of the year, and clearly tariffs were a big part of that. And I think over the first part of certainly from late February, early March, it became more and more into people's thought process, and they backed off essentially on the back of that. But broadly, I suppose just to finish those three examples, something's broken, an event, which if it's an event, it tends to be very sharp, but a very sharp bounce back. And the second one's more what I call a garden variety economic slowdown. And they tend to be probably more U-shaped, less, and that U can change. New Zealand's probably clearly been in that garden variety slowdown, taken longer, I think, but in some respects, you would typically see those as being somewhere between 8 months and 2 years. So we'd still sort of view the tariffs as falling somewhere between that event and the garden variety, rather than that something's broken. And in that sense, given markets, as you pointed out, were basically down 20%, it said that they'd priced in the vast bulk of that. So that was one reason why initially we took risk off the table on the back of tariffs, but we put it on pretty quickly and went back to essentially a fully invested position, and actually, the portfolios have benefited from that. And actually, the area that's probably nicest that has benefited is more in the inflation space, our balance space, where we're more focused on defensive names, the utilities, infrastructure, and property, or in New Zealand's case, property and retirement villages. And at the moment, that's 100% invested essentially in shares. So it is fully invested in the shares, defensive shares. And that's been an area that's generally been sought after, given the uncertainties. So that's they're actually well ahead of where they were at earlier in the year.
But the exciting thing about that from that inflation sector, our defensive shares, is part of the reason of having a separation between that and our growth is, especially for our clients who are sort of in retirement and drawing down some of their capital, that we want to have a part of their portfolio still compounding and still growing, but and because the biggest risk for someone in retirement is inflation, but you might not want the volatility that you get from sort of, I guess, more growthy type shares. And it seems what's happening is that's kind of what the whole market's thinking about at the moment is wanting those sorts of shares. And so those investors who are within that part of the portfolio, which are most of NZ Funds investors, but specifically the ones that are at or nearing retirement, it's a really good place to be, and that's what's bouncing back quite nicely because of the demand for those sorts of names.
Yeah, I think, the certainty of the cash flows of those types of names. And then, I think, probably not to make too strong a point of it, but we've come through this period of 5, 6, 7 years of US exceptionalism, where US has been dominant in terms of growth, both in terms of economic growth and share market performance. Maybe other parts of the world are not growing quite to the same degree, but they are growing, and in some areas increasingly so, even despite tariffs or despite the risk of tariffs. So actually, a lot of those sectors are quite GDP dependent rather than being tech or something, which is not. So, if GDP is growing, that means, in New Zealand's case, there'll be electricity demand, that sort of thing. So,
or if there's the perception that it will start growing, and I think that's the exciting thing about New Zealand is, it's been a tough couple of years, but there's green shoots when that starts flowing through. It's not tomorrow; it's over the course of 12 months, 18 months. But the market looks forward, and
well, that kind of hits the nail on the head, right? Is basically, in a nutshell, what we're trying to do at any point in time is say, well, what is the outlook, for different markets, and really you're trying to ask two questions. One, what is the outlook for growth, be it a company's growth or a country's growth, because growth will drive earnings and return. And the other side is, what is the outlook for inflation? Because clearly inflation drives where the cash rate is. And that's the starting point of all asset valuation, is if cash is low or in the extreme zero, then earnings in 10 years are worth exactly the same as they are today. Whereas if cash rates are very high because of inflation, then earnings 10 years away are only worth a fraction of what they are today.
And was that the catalyst there for even?
But sorry, I might just finish on that. The implicit question you're asking, which you touched on, is that once you ask what is growth and what is inflation outlook, market, basically you're to say, well, what is the market's expectation of it, growth and inflation, which is, it's when that expectation changes, which clearly they did on tariffs, that's when the market moves sometimes quite violently, and why it can change back quite quickly.
And before I interrupted you, and that's a perfect explanation for what I was about to ask you, is that's kind of what drove your decisions at the start of the year, even before we knew tariffs were coming in some degree. I think the whole market probably underestimated how aggressive they initially were.
And we did, yeah.
But at the start of the year, it was around growth and inflation expectations, and that drives sort of leads to earnings expectations, and just the view that American exceptionalism might not lead markets this year, but New Zealand, China, Europe, perhaps a look less sexy in terms of their growth outlook, but
actually the expectations were so low that, and I think it's still the case here in New Zealand, is that we are seeing expectations remain very low, and people don't expect much growth out of New Zealand. That sort of says, well, you don't have to have a lot, you've just got to have more growth than what people expect, and there'll be a positive surprise there. Whereas if you're expecting summer day, you're in the middle of February and you're expecting that weather to continue all the time, you're going to be sadly disappointed when you get to March or April.
I guess these things don't happen overnight, but sometimes you look back, say at the end of this year, and look back at the performance of some of these markets and realize they've, really outperformed, and because it doesn't happen over 1 or 2 days, that perhaps sometimes we're used to it, it sort of draws out over the course of a period of time, and they can grind away and actually generate a really nice, solid return.
And often they can be quite hated sectors at times, and ones that people have almost written off. Like a great example this year, or really over the last year and a half, is European banks. And obviously a lot of European banks have been a problem child, for use a slightly pejorative term, for a long time. Post GFC, we still had Credit Suisse. What was it, a year ago, 2 years ago? Ultimately fold and be brought or forced to buy by UBS. European banks have probably, certainly as at sort of, say, February or so, had kept up with the Magnificent Seven in terms of performance. Nobody talking about European banks, but they've kept up, and I'd imagine now are actually ahead, given their performance versus what some of the tech names have bounced back, but probably not to the same degree.
So to summarise that, reinvested the portfolios, after that initial bout of negative drawdowns in markets because of this sort of expectation it was an event rather than a
and given looking back at history, looking at the pattern of returns for events, or just the magnitude of typical drawdowns, typically somewhere in the region of 15 to 25%, and we were at 20 for some markets. So that sort of said the vast bulk of it was actually priced in.
And then, so now fast forward to today, and we're fully invested and I guess took advantage of those rebounded markets, and perhaps more broadly diversified across geographies.
Yep.
Europe, China, New Zealand, and obviously the US, which we still like. Just
Yep.
it was, we sort of, I guess it was an opportunity to take profit from the last 2 years and spread it around a bit more. What about now? Because as we talk, Bitcoin's at record highs. Commodities are certainly an interesting beast. Some are really have real positive attributes, and some perhaps look a bit weaker, like thinking about oil and things like that. And then when we think about some of these tech assets, actually they got quite cheap. So where do we sit on that? But also, what often goes undiscussed or not talked about. But then this week, a big theme in markets has been around bond markets and fixed income and government debt and that sort of thing. And so if we talk about that, and then I think that'll be a great segue into the economy in the US and debt and that sort of thing.
Yeah, well, I think broadly, in terms of our views, not a lot has changed. We came into the year thinking that the US was still a place where probably the best areas of growth would be seen, but actually expectations were really high. So we weren't negative, but just didn't feel it was going to lead the pack. And one reason clearly is that it's expensive. It's been performing for a long period of time, and we know that equity markets, share markets, ultimately mean revert around your sort of 10% per annum long run returns, and US shares have been doing quite a lot above that for a long period of time. So they, just history tells us that there will be a point where they don't do that. But yet, looking at other markets like Europe, China, and New Zealand being the key ones, those markets are cheap. They've underperformed. And certainly in the case of China and New Zealand, their returns over the last 5 years are at best very low single digits, and probably in the case of China, quite negative if you've been invested in that. But there's real catalysts in terms of activity, and because the expectations are low, we think, again, as part of that mean reversion, that you need a catch-up period where you will get that 10% return over a period of time, and it needs to play catch-up. So I don't think much has changed in terms of our view. We do want to be pretty highly diversified. We want to be across areas like China and New Zealand. We do want still some commodity exposure, and I'll include Bitcoin in that. We think there's very clear demand and supply dynamics which favour higher Bitcoin and higher gold. Things like oil, demand and supply is not quite as friendly, so we don't own that. But as I said at the start, and I think, again, coming back to the tariff issue, is ultimately tariffs are a part of a wider plan for the US administration to effectively look to deal with their balance sheet. How do they earn revenue, and where do they spend it, and how much are they? And sort of brings us to the budget here. I think very different. You can compare and contrast. They're very different situations, but ultimately for the US, that's what's driving. Where do they get their revenue from as a government, and where do they spend it, and have they got a deficit or not?
So should we talk about that? I think from a deficit point of view, it's I guess we always talk about New Zealand's in a real fiscal bind at the moment and has a lot of pressures around where to allocate spending. But if we touch on the US first, they've got a 6% budget deficit,
closer to 7,
and they want to put some tax cuts through, and I guess the market and bond markets didn't really like that too much over the course of the week. Can you just explain what was going on and perhaps where we ended up at the end of this week?
There's a lot of discussion about debt, be it here or be it in the US. The US has a lot of debt, about $30 trillion. A bit more gross than that, but there's about $7 trillion which is owned internally across the government. But close to, let's round the number, 30 trillion. Their economy is $30 trillion. So
this is federal debt, isn't it? This isn't state.
This is federal debt. So broadly, their debt is 100% of GDP. That gets a lot of attention. I actually don't think that nominal number itself is particularly problematic.
Because they've got a lot of assets as
There are a
well.
lot of assets. And there's plenty of other places that have got 100% debt to GDP, and it's not necessarily in itself a problem. Where their problem is more around what is their deficit and what is the speed it's growing. So if we think again about that $30 trillion number for the economy, their revenue is $5 trillion, which is, it'd be an interesting compare and contrast with New Zealand, because that's about, 16, 17% of GDP. New Zealand's a much bigger number relatively. 5 trillion, but they're spending 7. So they're generating a $2 trillion deficit.
So let's just break this down. So there's 30 trillion of debt.
Yeah.
5 trillion of revenue
a year for the government.
So tax.
Yeah.
And they're spending 7.
Yeah.
So not a very big revenue base to begin with, vis-a-vis the debt levels, and they're spending more than that. So it's getting worse.
Yeah.
It's funny. I remember 5 or 6 years ago, I was at a presentation to some of our clients, and we were talking. I can't even remember what we were talking about. New Zealand stocks or something. And someone in the audience, maybe they're listening now, put up their hand and go, "It's all very well that you talk about all this, but isn't the biggest problem in the world at the moment the size of the US debt?" And I think people are starting to talk about it now.
Yeah. But I think sorry to interrupt, but I think the critical issue is not the size of the debt; it's the speed that it's growing.
And that I think is the key, isn't it? It's because the size sounds large, but it's a big country. They've got lots of assets.
Correct.
But if you're spending, if you put it down to your personal life, your salary versus your spending, things can get nasty pretty fast if that continues.
Yeah, and again, if you think in that personal aspect, if you're borrowing, what are you borrowing for? Are you borrowing to buy a productive asset, or are you borrowing to go and splurge it on a holiday or something? It's what you use it for. And in the case of a business, very much the same. In the case of the government, a deficit in itself is not a bad thing if they're investing it properly. And at its simplest, you probably ask the question, is that deficit, is the growth in the debt faster or slower than the growth of the productive asset? And put it another way, how quickly is the economy growing? And usually, these again very round numbers, but economies grow at between 4 and 5.5% or 6% per annum by the time you bring in inflation. 2.5 real, X inflation, and then maybe 2.5 inflation gives you a 5% number. Now, if we look back through the US government debt or deficit from the 1980s, basically it ranged between minus 5% of GDP and plus 1.5, plus 2 briefly, outside of things like 08 and COVID. But pretty much since COVID, it's been in excess of 5, and it's currently just under 7%. So that means it's growing faster than what GDP is growing. And we haven't got the chart here, but if you put two charts together, you just get a growth rate. And, something that's growing at 7%, we use it from a return perspective a lot, but something's growing at 7%, it will double every 10 years. And if the economy is growing at 5, it's not going to double. So it's not so much the dollar number today, but it's the growth in that dollar number.
And then the issue is part of as that deficit gets bigger, the debt level gets bigger, the interest cost gets bigger, and it's sort of a bit of a death spiral.
Correct, exactly. So, and this is a little bit of a hobby horse of mine. I don't think there's a lot of discussion in New Zealand that we have all these debt problems, and the government's very focused on getting debt down. And yes, debt grew very quickly, but even now the deficit's sort of circa 2.5% of GDP.
So 2.5 versus 7.
Exactly, and our economy, it's been very slow, but we've still got 2.5% on inflation. So nominal, I think the forecast for the government fiscal year next year, which is a June 26 year, is for 4.9%, I think, growth, nominal growth, because we've got sort of 2.5% inflation. You get a 2% growth number on that, and then, so the economy is growing faster than the debt, so that's positive. And then again, our debt load is at 40% versus 100. So it's not I don't think it's the problem that many people see it as being.
Yeah, and we've always had to have a slightly tighter fiscal.
Yeah, I think there are reasons
because of where we are in the world, and our biggest exporter is agriculture and all that sort of stuff.
And earthquakes and things like that. Yeah, you want to be probably a little more fiscally sensible. But I think, again, this is a little bit of a hobby horse. Coming back to that issue of the US, they have $5 trillion and it's a very different economy, but they have $5 trillion of government expenditure versus a $30 trillion economy. What's that, sort of circa 16, 17%. Yeah. The New Zealand economy at the moment, so 400, numbers aren't quite as round, but 435 billion rather than trillion. Forecast, let's use to June next year, because that's a nice round number, sort of circa 450 billion is the expectation. Government revenue next year, 140 billion. So that is 31% of that GDP number, almost double the amount that the Americans take in terms of revenue. So that sort of says to me, and again, a lot of the discussion out there is it's not necessarily, I don't think we have a revenue issue in terms of the government. It's about what are we using that revenue to do? Is it building productive assets, or is it getting spent on other things?
Yeah, and part of that difference is a lot of the services provided in the States is at state level.
Correct.
But all the debt that we're talking about isn't state debt. It's just because you better believe it, the states have debt too. There's been states that have almost gone bankrupt that had to be bailed out by the federal government. And so it's not to say that necessarily New Zealand has got a high revenue because they just tax more. If you put it like including tax on state and federal, some states will be about the same as New Zealand. Some states will be a lot less because there are no state taxes in some states. I guess that's why everybody's moving to Texas and Florida. But it's I guess there's more centralized control in New Zealand to be able to make some of these changes and control that perhaps slightly better, for better or worse.
Yeah, exactly. And
it's interesting. I used to be. It's interesting that stuff like education's at the state level until you go to the US, and what does someone in Washington know about education requirements for kids in New York versus Wyoming versus Alabama? And you start thinking, actually, it kind of makes sense that the states have quite
it's
a lot.
all funded federally.
Yes.
But the decisions are all made at state level. So,
absolutely.
Which is, the joys of a very big economy. I think probably just the one point I would make about the US is, and obviously the natural question for people to ask was, why do you have investments in the US if their deficit issue is such a problem? Was actually, if we look at the wider balance sheet and say, what is the balance sheet of USA Inc., it's actually really strong, because the government's been growing their debt quite quickly, but actually post the GFC and all the housing issues they had there, most Americans have actually really delevered. And if we look at something just like their mortgages, over the last 15 odd years, since 2010, the US economy has doubled from a $15 trillion economy to $30 trillion. We're right, we really are sort of just dominating with numbers, aren't we? It's doubled in that sort of 15-year period. The US government debt's tripled. Actually, private mortgage debt has gone from 9 trillion to 14, sort of a 145% increase, or 45% increase. So, less than half the growth of GDP. So actually they've moved from a situation where you'd say, well, how much equity do I have in my country versus how much debt? They're about 50-50. They're now about a third debt, 2/3 equity. So they're as an economy, it's very robust. It's just the government's got some issues.
This is a whole other topic, but housing market's probably got a lot to say. It hasn't skyrocketed like it has here. Therefore, mortgage levels haven't needed to increase, and it's a lot of space, a lot of different markets, different drivers and things. But it's certainly interesting that the focus is on that debt level in the US, but actually you can kind of see why. Well, you can, whatever your view on the politics is, you can kind of see why they wanted to generate more revenue in other ways, because the revenue's so low. And one way to do that, well, you can raise taxes, but no one likes that. But you could put tariffs on and blame it on other countries.
Well, I'm not sure this was necessarily thought through, but you could view one lens to view tariffs is it's kind of like a pseudo GST. GST, we pay all of the GST, whereas the tariffs partially the US consumer pays and partially maybe somebody else pays. So you could view it a bit like that. But again, we'll find out in time whether it was thought through this to this degree. But yes, tariffs were a way to increase revenue. Doge potentially a way to cut costs more. And then the third leg is really, and we haven't really, well, certainly tax cuts, or Doge was there to counter potentially more spending through tax cuts. The third leg is possibly that sort of area of banks. And, interesting that Governor Willis has asked for a review of sort of banking regulations here and capital requirements.
Minister.
Sorry,
She's not the governor of the bank quite yet.
Yes.
Minister of Finance.
Minister of Finance, yes. Banks haven't grown assets globally since the GFC to the same degree that the economy's grown. And that has been restricting activities. So the US is very keen to actually see, well, maybe not change banking regulations dramatically, but encourage banks to lend more, and which will stimulate growth. So I think,
and it kind of makes sense. They want to do it at the regional bank level, and it kind of makes sense because in your region, you know your economy, and therefore, if you can lend more to smaller businesses and things, that's a real positive thing to do. And I guess the same you could argue is happening in New Zealand. You've got Australian banks dictating how much they're lending here, with quite tough regulatory requirements as well. And actually, if that's loosened to suit New Zealand, rather than just copy the Australian regulation and start leaning a bit.
Well, certainly this gets off on another tangent, but that was one of the question marks that certainly the Reserve Bank under Governor Orr, get the terms right this time, was very keen to actually continue to increase those capital levels. And my personal view is I don't think that's needed. And that would have actually reduced activity rather than. And I think it's an interesting segue in terms of the other parts of the budget, in the sense that it was nice to see them actually focus on some capital incentives and additional depreciation for first year for new capital purchases and plant and equipment, machinery, tools, because ultimately New Zealand's productivity has been very poor in recent years, and if we look at somewhere like the US, they've frankly just been much more productive. And how do you get more productive? It's generally having more capital equipment. That is simplest. Maybe that's too simple, but I think that's a good start to try and ultimately lift that growth rate.
Yeah, it's twofold. And the first phase is just buying more stuff. There's an incredibly loud motorbike going past us. We're 16 levels up and still hear it. Initially there's a great catalyst of activity because of that buying of the capital good, but then also the long-term product
makes it more efficient, right? So I think that is it's nice to see that acknowledged, and
better than a tax cut for corporates in some ways, because it's proactive and looking forward rather than retrospective.
Very much the case, and I think the other one, which has got quite a lot of attention clearly, is the KiwiSaver changes. Yes, question marks over incentives in terms of the annual payment from government. It would have been interesting maybe if that had stayed. Probably the $180,000 a year threshold means testing makes sense. It does create probably some complications along the way for things like some of the modelling. Again, actually raising the contribution rate is what New Zealand needs to have, and we've said many times, have a fully funded retirement, we need to save more than 3%. And why is Australia doing well? They've got 10 to 12% contribution requirements, and that's why when it's growing that quickly, a country with a savings base like that will be wealthy.
And I think that some of the changes around the government contribution is just a reminder that when we talk about maintaining or creating a fully funded retirement, you have to be self-reliant to some extent. So a good example is they changed these rules quite quickly with not much notice. I think this wasn't being talked about a year ago. They also, if they can do it to that, what else can they touch? Well, there's the big elephant in the room is what are they going to do about New Zealand super? And the means testing this government contribution to KiwiSaver. Do they start means testing super, retirement age? And I think all this is saying is KiwiSaver is fantastic, and it's been a great start to get New Zealanders thinking about savings.
Yeah.
Even at 4+4, that's 8%. Like you said, it's lower than in Australia. Well, the savings rate in China is 40%.
Yeah.
And so, we've got a little bit to go. I'm not saying we need.
They don't have a social safety net.
They don't.
Social welfare net. Yeah.
And so I think it's just a reminder that everybody should be doing as much KiwiSaver as they can. There's some opt-out clauses, isn't there? If the cost of living is too tough to do that full 4%, but it's also being phased in over a few years. But I get it doesn't change that message that contributions need to come up, and they have done, and that's a positive thing.
Yeah, and I think it is interesting that superannuation is actually getting talked about more. I won't name them, but another sort of somebody's aligned to another fund manager out there this morning made the point, which I hadn't thought of before, is rather than raising the retirement age, why not have the first 5 or 10 years means tested? It would seem a really interesting way to do that. Yes, so once you get to 70 or 75, you're eligible, and if you regardless whether you need it, you get it, but actually those who don't need it to start with. And, again, coming back to the numbers, there's a lot of talk about health and education, but in terms of that, spend the government has, 11% of GDP is on social security and welfare, and more than half of that, I think it's, over 5% of that is superannuation. And then you go to things like health. Health is 7% of the spend, education less than 5%, law and order 1.5%, transport 1.5%, defence 70 basis points. So it is kind of the big elephant in the room.
Yeah, and I guess that there's always going to be discussions, and I really like years ago, Helen Clark was asked, do you like, what do you think of capital gains tax? And she talked about all the positive aspects of capital gains tax and thinks it's a tax to have. And then she followed quickly with, but I also like being Prime Minister. So it's not going to happen then. And I think that's been the view around super and retirement age and those sorts of things. I remember John Key, so that was one of his bottom lines, that he wouldn't touch any of that. But all it's doing is kicking the can. And for those that are sort of further from retirement, you need to kind of think about that can might have to be stopped being kicked down the road and start doing it yourself.
Yeah, and again, I think it does come back to that question mark. And clearly we have views on one side of the fence, but there are others out there who are arguing for much higher levels of tax. We're already taking more than 30% of GDP in government revenue in tax. That sounds to me that that's a pretty big number. That's higher than we've historically had, and actually does they don't have a revenue issue. It's about how they spend it and find ways to spend. So I think the other one that is, in terms of the other aspect that was interesting for us in terms of the budget, is that, again, trying to think back to those simple questions. Where is growth? Where is inflation? And, where does growth come from? It comes from consumption. Is that private consumption or is it government consumption? And in that sense, clearly in the US, if they're running a 7% of GDP deficit, the government's consuming a lot. They are driving quite a bit of consumption at the moment. Here, government's been contracting. And, there was, based on the sort of prior numbers, they were actually, there was forecast to be quite an influence last year in terms of government consumption, still spending. They spent actually quite a bit less. So there wasn't that push, that growth push from the government. But originally in the previous forecast, there was quite a decline. People sort of say, well, actually the deficit is still quite large. They were actually forecasting we're going to shrink that deficit a lot, which is actually taking spending out of the economy. The fact the deficit is still around that sort of 2.5% level actually means that it's a slight positive for economic activity at the moment going forward. And that's a good thing, I think, given where we are in the cycle, is we want to
But
have the government. Yeah, we want to have the government stimulating. We've got interest rates coming down, and Reserve Bank will expect to cut rates again next week. All of that's going to be. We're seeing it happens probably slower than we would like, but you're seeing slow signs that New Zealand is starting to grow. Small steps, but it's starting. Very much more southern based than sort of in the urban areas, but urban will follow.
Yeah, and that I guess reflects New Zealand's makeup of export commodity recoveries happen from the south, which we've talked about before. Was there anything in the budget? My biggest bugbear, I guess, in all governments, left and right, is not enough of thinking about infrastructure and things that will grow the economy and make it more productive and get us out of this mindset, or especially Auckland mindset of property as the way to generate wealth for New Zealanders. And actually, there's lots of other ways. Was there anything in particular in that part of the budget?
Not a great deal that I saw. Again, I suppose the numbers I've got here are core spending, so it doesn't include some of the big CapEx numbers. But transport at sort of 1.6% is a pretty low number. So yes, additional spending like that would be positive. And I think again, it's part of that discussion about. I think it's a slightly misguided discussion in New Zealand that we have so much debt. Yes, we do have a lot more debt than we used to, but it's sort of 40 to I think it's forecast to get to 46% of GDP. Yeah, it's higher than it was, but if we're using debt for productive measures to build infrastructure, to build transport, to basically make life faster and more efficient, that would be a good use of.
There's a return on that capital.
Yeah, exactly, and as long as you get that return, that's a good thing to be doing, just like a business would, just like you would in your personal life.
So I think probably we can move on from the budget.
We've scared everybody with too many numbers.
Yeah. But I guess why it's interesting is New Zealand, I guess, from a share market point of view, has been waiting for some of this, I guess, economic stuff to flow through to see, are we really, on the right track for an earnings revision upwards, so shares go up. And I think it's fair to say there's some, looking at the budget, looking at some of the catalysts that may cause sort of productivity to increase and activity to happen, things in New Zealand look pretty good. And then I think having a decent allocation of the growth assets into New Zealand is going to be a positive thing for portfolios going forward.
Yeah, look, I think at its simplest, if we look back over the last 5 years, the annualised return out of New Zealand shares, including dividends, has been about 2.6%. Go back for the prior 5 years before that, it was like 15. We were way over earning. We're massively under earning at present, and we would expect, over time that will return to a 8 to 10% number. So, to do that, companies have got to perform, they've got to earn, and that'll be reflected in price. And I think, with interest rates coming down, and one of the big things with interest rates at the moment is we've seen decent interest rate cuts, but it's still only just now flowing through. I think the peak and the average, the RBNZ has a series, they have a peak of the average mortgage rate was 6.4%, I think, across all mortgages. That's what people were paying on average. That's come down to 6%, but it's still a long way from the carded rates of just under 5%, etc. So there's a lot of scope for that to come down, which will put money in people's pocket and just encourage activity, I think.
Yeah, some of that will be saved, but some of it will surely be spent. I know in my household, it's certainly gets spent with 2 young kids.
Yeah.
So, Mark, is there anything else that we're going to discuss today? So I think it's been we've sort of gone around the traps, which has been fantastic. So we've talked about what I guess the implications of tariffs, but where we are now, the portfolios are well positioned, and we've talked about the New Zealand budget and some of the implications and the comparisons to the US. Let me spend 2 minutes telling you what I've been doing the last few weeks. I've been going around the country. I think I've had, along with our financial advisors, over 130 meetings with accountants, talking about the state of people's retirement in the sense of, do they know what they're aiming for? And do people understand what their wealth target is? And what does that mean? And what do they need to do to meet it, to have a fully funded retirement? And it always reminds me, every May when we go through the budget, it reminds me that there's so much media intensity on what the government are doing.
Yeah.
Perhaps we should put that same intensity of what we're all personally doing to make sure that our budget's in line. And I think it's a good reminder that, having a financial advisor talking about what, or trying to work out what your wealth budget is using some of the cool software that NZ Funds has built. But also, if you already have one and the clients that are listening will have some sort of plan, reassessing that and going through it and making sure it's fit for purposes and I think like the fire station gets you to change your batteries in your smoke alarms on daylight saving, the budget in New Zealand is a good time to actually reassess your own circumstances and have a think about it as a family or as a couple or however you think about these things is super important. And it's never the wrong time to start thinking about and invest.
Well, I think, again, as I sort of said in the way in which we approach investment decisions, trying to boil it down to simple questions. What is growth? What is inflation? Same way, in terms of personal financial circumstances, where am I going? And what is my roadmap to get there? Do people have that? Yeah.
Yeah, exactly. That's all we're trying to do, isn't it? It's actually simple when you think about it. And we've probably got a few less levers.
And what do I need to do to get there?
Yeah.
That's probably the third one.
And those are the levers. And thankfully for us, we've got a few less levers that we have to worry about compared to the government.
Correct, yeah.
Which don't envy Nicola Willis on budget day, that is for sure. Hey, Mark, thanks so much for joining us. It's been a really good summary of the last 6 weeks since we last spoke. You're going to be doing some interesting discussions and meetings with some of our external managers over the next few weeks. So I would love to get back and talk about how they went in their view of the world. So
get their perception on life and see what it's actually like in the US at the moment.
Yeah, great. Well, thanks everyone for tuning in, and look forward to speaking same time, same place in a couple of weeks.